Welcome everybody to Volatility Trading Strategies. So unfortunately today's topic does come to us as we are losing a member of our VTS community. Let me show you what I mean. Please discontinue my subscription. I appreciate your past service and ongoing blog, but I just can't invest in this overvalued market. Good luck to you and your services. I may come back, just not now. So Peter, I am sorry to see you go, but please feel free to come back anytime. I'm going to be here for many years, so there's certainly no urgency. When you are comfortable, you'll know where to find me. Now, I don't get that many people leave the service, but when they do, it's nearly always because they're looking for more aggressive trading. I am admittedly a fairly conservative investor, and sometimes that's just not what people are looking for. But with our friend Peter leaving for the opposite reason, because he feels he just can't pull the trigger on the trades because of extreme market valuations, I thought now would be a good time to talk about this. How do we invest when markets are so overvalued? So I won't spend too much time on this, but it is important to scrutinize that premise that markets are in fact overvalued. If they're not, then I could just politely disprove that to our friend Peter and reassure him that he has nothing to worry about. But the truth is, he's not wrong. This is in fact the second longest bull market in history, and if we make it to Christmas of next year, that would break the all-time record. Now, this by itself doesn't mean markets are overvalued. Every bull and bear market is different and should be treated differently. Having said that, this is 100 years of data, so we need to pay attention to the fact that we are in rare territory. Also of note, when longer bull markets do end, they typically see a pretty significant decline. Not always, but usually. The Shiller PE ratio is a variation on the basic price-to-earnings ratio, which also takes into account an average of 10 years of earnings. Of course, no single metric can ever tell the whole story, but the Shiller PE is a pretty solid indicator for general valuation. And as you can see, we are again in rare territory, only outdone by the longest bull market in history during the 1990s. And we all know how that one ended. And lastly, the S&P 500 price-to-sales ratio, which takes into account company revenues rather than earnings. And again, no surprise, we're at extremes, in this case the highest level in history. This shows that stock prices are far higher than their underlying revenue indicates. So there's no doubt that we're seeing extreme market valuations. And I'll leave all the reasons to a future video, but one of them is just simply, in this low interest rate environment, there really aren't a lot of places for investors to get a decent rate of return. So seeing people pouring into equities isn't surprising. But that doesn't mean we have to follow the herd. The vast majority of investors out there are disappointed with their long-term rate of return, and the average active fund manager doesn't even get 5% a year in the long run. So the last thing we want to be doing is following the crowd. Being cautious right now and taking fewer trades does make sense, which is exactly what my fund has been doing for the last year. But in my opinion, we do still have to continue trading. Calling the top and moving to cash is actually just market timing, and that's something that I don't believe in. The number of times that people are right in their predictions are usually overshadowed by the number of times they're wrong. Imagine trying to time the markets during the financial crisis. When was the bottom? It would have been easy to make a case that the worst of it was over by October or December. And on the flip side, trying to call the top in recent years again has been futile. Many financial experts said it was here, and then here, and then here. We can do this every month, and eventually one of these calls for the top will be right. But that's not how to get a good long-term rate of return. I believe the key to long-term success is controlling emotions, trading 100% systematically, and just following a system of math and probabilities. Obviously, the underlying systems need to be dynamic and take into account market trends and valuations, but it is very important that we continue following the signals regardless of how we feel about them personally. And remember, there's absolutely nothing wrong with getting a lower rate of return when market valuations are stretched. People should get a higher rate of return during the earlier years of a bull market, and then tapering off towards flatter returns when it's been going a while. But I do believe that when people start trying to call the top and bottom and use market predictions to influence their decisions, at that point their future performance is mostly based on luck. For me personally, I design strategies that will be allocated to trades when conditions are ideal, but are also very quick to move to safety positions and hold more cash when that's no longer the case. This way we don't have to call the tops and bottoms. If this bull market continues, we can still participate. The rate of return likely won't match our best years because now is obviously not the time to get aggressive, but we can still participate in future upside. And if things do fizzle out, we'll move to our safety positions. But it won't be because of market timing or predictions. It'll be because the extended set of indicators I track will signal us to do that. Many years ago, I was a professional golfer, and I can tell you from personal experience, success is far more dependent on controlling emotions rather than actual physical ability. At that level, everybody can swing the club. Everybody can hit all the shots, but not everybody controls their emotions. The best players are the ones that rely on their past work and their systems, regardless of the situation. You don't try harder or focus more just because it's the last few holes on the final round. If you want to win, you do the exact same things that got you there in the first place. Calculate the distance, adjust for elevation and temperature, check the wind, then go through your pre-shot routine and pull the trigger. Emotionless, with confidence because you've put in years of work. Investing is the same. Long-term success comes from controlling our emotions and following the systems that got us here. With markets so overvalued right now, I completely understand why some people want to just pull the plug and cash out, but that's an emotional reaction. For me personally, I'm going to rely on the robustness of the strategies that got me here in the first place. I'm going to trade like a robot. I know that I designed them to move to safety positions when markets are ambiguous. With valuations where they are right now, it's certainly possible that forward returns are lower than they were during the earlier stages of the expansion, and there's nothing wrong with that. Believe me, if the average investor out there beat the S&P 500 by a little bit during bull markets and didn't lose quite as much during bear markets, they'd be very pleased with their long-term performance. Now, of course, I strive to do much better than that, but we don't have to shoot for the moon here. And in fact, when people do that, it usually leads to failure. So back to the original question. How do we invest when markets are so overvalued? Well, the answer is simple, the same way we always do. By following conservative strategies, maintaining proper position sizing, and having the confidence that the past work has been done, and our swing will be there when we need it. So if you have any questions at all about this video or any of my other ones, feel free to reach out anytime. I'm always here to help. Thanks for watching. So go ahead and click the link right here, sign up for the VTS newsletter, and when you do, you're going to get full access to all of my trading strategies for a full month absolutely free. And if you are new here, please consider subscribing to my channel. Also, if you have any questions or comments, I'd love to hear from you. So go ahead and leave those in the comment section below. See you next time.